Get our guest on board. Gautam Duggad, the head research institutional equities at Motilal Oswal Financial Services, joins us now to tell us what he's expecting of the market and different sectors. Gautam, good morning. So much to chat about. My memory goes back to the conversation that we had a few months ago when you were still cautious on the market. But a couple of days ago, you told me about how this market perhaps is all set to rebound, and there could be further upsides purely because of valuations that are looking now attractive compared to other emerging market peers and growth that is coming back in some sectors. Just tell us about your market view. Do you think that this is a market that can see a fresh leg of an up move, or will we just not fall as badly as our global peers perhaps?
Good morning, Sonia. Thanks for having me. Yes, the valuations have corrected purely because of the time that we have spent in this range for almost more than a year and a half. If you look at the index, October 2021, we were at 18,000. And now in March or April 2023, we are back at the same level. In between, we have seen a very decent earnings growth given the kind of headwinds that were prevailing, both at macro and micro level. So valuations which were at 21 times back in October 21 at the same index level, today they're at somewhere about 18 times. If you look at the underlying corporate earnings, if our expectations pan out for this quarter, we will end the year with about 13 to 14% nifty earnings growth, right? Which will come on a base of a very high 35% growth that we've delivered in FY22. So it's a very healthy sort of earnings growth, I would say, given the kind of macroeconomic context which is currently prevailing, both on interest rate side, geopolitics, and so many other developments which keep on happening. And one cannot ignore the fact that 2H FY23, the Indian economy itself is in a slowdown phase with a GDP growth of about 4.5%. So when you look at this equation of price and value, it looks that risk reward is slightly more favorable now. Having said that, on a relative basis, we are still slightly more expensive than the long period average, which I think we deserve to, given the kind of growth that we have seen in the last 3 years, and the corporate ROE is inching up upwards of 15-16%. As regards your question on further up move from here, I think it will be a blend of two things. How the whole interest rate environment pans out going forward, and second, whether the expectations of a 15 to 20% earnings growth that we are having for FY24, does that see any material damage because of the current sort of a moderation in the broader growth environment that we are seeing. So far, the corporate earnings have completely diverted away from the prevailing slowdown at the macro level that we are seeing. Remains to be seen if it continues in FY24. If it does, then obviously we have more legs to this upside.
Gautam, morning. You recently moved consumption to an overweight. Can you explain the rationale? Because if we do have deficient monsoon due to El Nino, rural sentiment gets hit, then again the consumption basket, whether in FMCG or on autos, hurts. So can you explain this consumption overweight stance that you've taken now and the upgrade?
Yeah, so the worries on monsoon, El Nino, deficient monsoon, etc., I think sometimes we make a lot of noise about it. Ultimately, a normal monsoon gets classified as 97% of a long period average to about 105%, right? If you go by yesterday's SkyMet prediction, they're talking about a 94%. If you look at the last 5-6 years of monsoon, we've seen a consistent trend of a very positive and a normal monsoon. What has that ensured? That has ensured that the reservoir levels are much higher when you compare to a 10-year average. And even compared to last year, the reservoir levels are at about 96% today versus last year. So while it can be a deficient monsoon, I don't think it is going to result in any kind of a catastrophe as far as rural incomes are concerned. Second, consumption stocks per se over the last 3 to 4 years have had a massive time correction. I mean, barring ITC, most of the consumer staple stocks are around the similar levels where they were 3 to 4 years back. In between, you've seen some cumulative 30-35% kind of an earnings growth on a 4-year basis. So obviously, the valuations have petered down a little. In the short term, there can be a concern on some of these stocks, given the slowdown on rural and stuff like that. But I think risk reward, again, for consumer stocks have turned more favorable. So what we've done in our model portfolio, we've increased the weight of consumer stocks and added few more stocks. So we already had a large weight to ITC. We've allocated 100 basis point more there. We've added Indian hotels. We've added Vedant Fashion. Aside of that, we already had Titan, Godrej Consumer, and Metro brands. So now we are having about 200 to 300 basis point of an overweight stance there.
Hi Gautam, good morning. Gautam, from the start of this year, that's from FY23, how much have you all scaled down your Nifty EPS? In the middle you had scaled it down by 2-3%, I think so. So what did you start off with? Where do we end FY23 with? And what are you factoring in on a Nifty EPS absolute number, say for FY24 and 25?
Yeah. So FY23, Nigel, we will end with 812 as per our current estimate. This quarter, we have not seen any change. So we are at a similar levels on Nifty EPS for FY23 where we were in February, right? To answer your question, at the beginning of FY23, our EPS estimate for FY23 was 850 rupees. So over the last 12 months, it has come down by about 4 to 4.5%. Now, despite that, we are still about to end the year at about 13 to 14% growth, which, as I said, on a base of 35% growth in FY22, I'll still consider it as a very healthy sort of a growth, because back in April 2022, we did not anticipate a 300 basis point or 275 basis point kind of an interest rate increase. Or maybe, sorry, I stand corrected. It's about somewhere about 250 basis point of a repo rate hike. So given the way things have moved in the last 12 months, I would reckon this 13-14% growth in Nifty is still very, very healthy. Going forward, right now, we are talking about an EPS of 978 rupees, which basically amounts to a growth of about 20%. Large part of it is led by two sectors, which is banks and auto. Auto is coming back after 5 years of a slowdown, where the profits of auto companies in Nifty from FY18 to 23 have declined by 20%. So it is making a comeback, right? Second, on financials, which has already been on a tear for last 5 years, so profits have been up 5 times between FY18 to FY23. We are now expecting about 17 to 18% growth out there. And third component, which might drive some recovery in earnings in Nifty in FY24, is a marginal rebound in the absolutely depressed profits of metal companies, where the profits have gone down by 2/3 between FY22 to FY23, where we are now expecting some recovery in FY24. So if you account for all of this statistical variations from different sectors, you reach about 20%. If you look at the numbers excluding commodities for our forecast for FY24 Nifty, we're talking of about 16% earnings growth in FY24.
Okay. By the way, I just want to mention some stocks, and the market is actually holding on to its gains pretty well. So don't lose sight of that. It's almost an 80-point gain on the index. And this is after a 6-day rally. So this is looking pretty good. The pullback has extended itself really well. Data Patterns is the stock that I'm talking about. It's a fresh high for Data Patterns this morning. And, you know, this company, as we know, Data Patterns is in the business of providing services for defense electronics, so largely in the defense space, services for light combat aircrafts, for helicopters, nano satellites, etc. This space, Gautam, has had a phenomenal run, right? Whether it's the main players like a BEL and HAL, or even something like a Data Patterns. If someone has missed the rally here entirely, does it make sense to buy afresh, or is it too late?
I'm afraid, Sonia, we don't have coverage on those stocks yet, but all I can say is that some of the stocks have had a phenomenal run, whether Hindustan Aeronautics or Bharat Electronics. So unless someone is already holding it, whether a defense play or some of the celebrated capital goods names, from a risk reward point of view, one has to be extremely, extremely cautious there if one is trying to, contemplate a fresh entry. Right, but right now we don't have a coverage on this. So on numbers, etc., we will have a very little clue as to how they are panning out.
You recently added Godrej Properties as well. Are you convinced about the numbers that we are getting from the real estate companies and whether these can sustain going ahead as well? Because the March quarter would have also got the benefit of that capital gains arbitrage, which comes to an end from 1st of April. So this quarter's numbers, Jan to March, would have also seen a bump up on account of that. So do you think these numbers that we've seen from Shobha Developers or Godrej Properties can be extrapolated into the future?
So, Rima, for example, specific to Godrej Properties, what we are building in, and we've had an extensive discussion there, FY24 can look very good for them. FY23 obviously has been a blockbuster, best year in the recent times. As far as pre-sales, development, new launches, business development is concerned, I think They had given a guidance of about 16,000 crore at the beginning of the year, and they're ending with roughly 32,000 crores of development. So it's almost 2x of what they had guided for at the beginning of the year. Next year also, they're guiding for a very good growth in FY24. What is changing materially for Godrej Properties from our point of view is that whatever development that they have announced, whatever construction that they are right now, WIP, as it moves forward in the next 2 years, you will see it impacting the P&L positively as far as margins are concerned. So profitability, which was a concern for this stock for some time, is getting addressed. Second, the aggression on business development and new project launches is back. And third, the stock had corrected materially from its highs 2 years back. So all of those four, when you aggregate that, essentially meant that the risk reward there looked quite attractive. And that was the reason we added it in our model portfolio last week. And of course, it is also followed by a rating upgrade for the stock. As far as the rest of the sector is concerned, the other stock that we like is Lodha, where also we are seeing a quite positive development as far as pre-sales are concerned, as far as balance sheet is concerned, and cash flow is concerned. So this sector obviously is also benefiting from the recent pause in the monetary tightening that we have seen in the latest RBI policy. So sentiments have improved for this sector. So right now, and given the high beta nature of the space, you are seeing the kind of reaction that you have seen for some of these stocks in the last 3-4 days.
Okay, one final question then before we let you go. I mean, I know it's just, sort of crystal ball gazing, but nevertheless, what is the expectation from the tech pack this time? It's going to be a weak showing and there could be some headwinds that these companies talk about. But do you think the time has come to, put some money to work here? Could it be the end of the downfall for the tech companies? Your thoughts?
Yeah, Sonia, I agree with that. I think as far as this quarter is concerned, everybody is aware there's going to be some softness sequentially compared to the third quarter numbers, given the developments that we have seen in the US banking industry. I think people will pay more attention to the commentary on FY24 and the guidances that some of the large cap companies will provide for the full year ahead. Third point is that this has been the worst performing sector in CY22. The NSE IT index was down 28%. So clearly valuations there have become far more palatable today. Historically, we've always liked this sector given the strength of the cash flows and, of course, the high payout ratios. So we are positively biased towards large cap IT stock, and we think that the recent correction which has happened has changed the price value equation very favorably towards this name. So and of course, we don't expect any big downgrade in the growth guidance. I think we've heard a lot of noise on US recession, Europe problems over the last 12 months. So far, we have not seen any material growth guidance downgrades from any of these companies in the last 2 quarters. So I'd be surprised if there is any big downtick in the guidance that we see in the next 2 weeks.
Okay, thank you very much, Gautam, for joining in. Now